Welcome back to the deep dive, where we take these dense, complicated systems that, govern our lives and we try to break them down.
Yeah.
Today, we're focusing on financial security when it is needed most.
We are.
We are diving deep into the intricate, sometimes pretty painful mechanics of the life insurance claims process.
Look, this is a critical deep dive for everyone listening. When a life insurance policy pays out, it's usually during one of the most stressful, emotional periods for a beneficiary.
Right. Confusion is high.
Confusion is high, and mistakes can be really, really expensive. So our goal is to sort of pull back the curtain and act as your expert guides. We're going to track that claim step by step.
From the very beginning.
From the moment the paperwork starts all the way until the money is wired.
And we're not just looking at a checklist here. Our real mission is to highlight those non-obvious factors, the specific decisions made years earlier, or even mistakes made on the initial application, things that ultimately determine the speed and the final actual value of that death benefit. It turns out the number printed on the policy is often just the starting point. Okay, so let's start right at the emotional center of this process, initiating the claim. When the life insured passes away, who actually has the authority to submit that first piece of paperwork?
That authority rests with the claimant. And in, I'd say, the vast majority of cases, that is the named beneficiary on the policy.
Okay, so the person who's supposed to get the money.
The person who gets the money. If, however, the policyholder failed to name anyone, or if the beneficiary is already deceased, the payment defaults to the deceased person's estate.
And what about the life insurance agent? The person who set up the policy in the first place? In that first chaotic week after a death, what's their role? Are they still involved?
Oh, they are absolutely critical. They act as the primary facilitator, and they have to handle the process with the sensitivity the situation demands. Their job is to supply the claim forms, help the claimant understand and complete them, and also discuss the various ways the funds can be received, the settlement options.
That sounds like a pretty proactive role. So if they become aware of the death through, say, community connections or something, can the agent reach out first?
Absolutely. Yeah, they are encouraged to be proactive, and this is where a professional boundary is crucial.
Right.
The agent must never, ever give the impression that they are the decision maker.
So they're not the adjuster.
Not at all. They can facilitate the process, but they cannot tell the claimant, hey, your payment is guaranteed or it's going to arrive on this date. That decision is strictly up to the insurance company's claims department. The agent is the empathetic coordinator, not the underwriter.
So the agent gets the paperwork started. Now let's go behind the curtain and see what the company does with that claim. It moves to the claims examiner, who I imagine has a massive verification checklist.
That's exactly right. The claims examiner is the gatekeeper, and their first priority is just verifying the policy's validity and gathering all the required documents. They have to be rigorous.
And what's the number one check they run? I assume it's just, was this policy even active?
Exactly. The first, most fundamental check is confirming the policy was in force at the time of death. This sounds basic, but it trips people up all the time.
I can imagine.
The policy is not in force if the policyholder simply stopped paying premiums and let it lapse, or if they surrendered the policy years ago to get the cash value, or maybe it was just a term policy and the coverage period had expired.
Okay. So if the policy is valid, then the examiner moves to undeniable proof of loss. What official documents are we talking about here?
They need official certification. So typically a provincial death certificate, maybe a funeral director's certificate, or a coroner's report, something that confirms identity and the event itself.
Now, here's where the investigation gets a bit deeper. For larger claims, the insurer often requests the attending physician's statement, the APS. What's the significance of that document?
The APS is where the rubber really meets the road. It certifies the medical cause of death. And for the insurer, this document lets them do two critical checks. First, they verify the cause of death against any explicit exclusions in the contract.
Okay.
And second, they cross-reference that cause of death against the information provided when the policy was first written, looking for misrepresentations.
And this is where a claim could potentially be denied entirely, correct?
Yes. There are two primary denial triggers that an APS can reveal. The most common is suicide.
Right.
Claims will be denied if the APS shows death by suicide, and that suicide happened within the policy's initial 2-year exclusion period.
And a second trigger.
The second is if the death resulted from a specific high-risk activity or cause that the policy explicitly excluded from coverage from day one.
That makes perfect sense. So once they've validated the policy and the death event, The final confirmation is just who actually gets the check.
Right. We move to confirming the beneficiary's identity, and if the primary beneficiary has already passed away, the insurer needs proof of that death before they can pay the contingent or backup beneficiary. This can introduce really frustrating delays.
I remember seeing an incredibly helpful example in our research about how a specific designation can save enormous headaches here.
Think about Hugh. Hugh wanted his children to benefit. If he had vaguely written "my children" as his beneficiary,
Just my children.
just my children,
Yeah.
the insurance company would be obligated to delay payment while they do a full investigation, contacting family, running checks to make sure they identified every single person who qualifies under that class.
That's the cost of being vague.
Precisely. So Hugh, he avoided all this by writing, "All of my children, including those not yet born, from my marriage to Jane Doe."
Wow, that's specific.
It's specific enough to close the door on any investigation. Specificity is clarity, and clarity equals speed in this process.
Just a quick note on group life claims. Do they follow the same path?
Generally, yes, but the process is handled by the plan's sponsor, usually the employer, not a life agent. The examiner also checks two extra things. Did the deceased satisfy any waiting period, and were they still employed at the time of death?
Okay, let's unpack this crucial legal and financial risk. Probate. I hear this term constantly. Is that basically just a provincial tax applied to the assets left in a will?
That's a pretty good way to describe it, yeah. Probate is a legal process that confirms the will is valid, and most provinces then charge a fee or a tax on the assets passing through the estate. It can be a hefty charge.
Except in Manitoba and Quebec, right?
Right, they have different systems. But for most of the country, it's a factor.
And this brings us to one of the biggest, most underestimated benefits of life insurance.
It does. If you name a non-estate beneficiary, so a specific person, a trust, the death benefit is paid directly to them. That payout is entirely exempt from probate tax.
Which is a huge double advantage.
A double advantage for the beneficiary, exactly. You effectively increase the benefit's value by avoiding the tax, and you dramatically speed up the payment because the insurance company doesn't have to wait for the court system to validate the will.
So we've gained speed and value, but when is life insurance not exempt from probate? When does it get sucked into the estate?
It still applies if the policyholder names the estate as the beneficiary or if they just didn't name a beneficiary at all. It also applies if there are no living beneficiaries to accept the funds, or if the only beneficiary named is a minor.
Okay, so if the estate is named, the claims examiner needs some assurance that the person claiming the funds is legally allowed to do that.
That's when they require letters probate. You can think of that as the court-issued badge that verifies the executor's legal authority.
And if someone dies without a will?
That's called dying intestate, and that automatically forces the assets, including the insurance proceeds, into a much, much lengthier and more expensive court administration process.
And what's the difference in Quebec? I know their legal system is distinct.
It is a bit different. In Quebec, if the will was a notarial will, so written before a notary, it's deemed authentic. The adjuster just needs a copy.
Simple enough.
Yeah. But if the will was handwritten or just witnessed, it has to be validated or probated by a notary or the superior court.
Oh, and a quick note. The executor in Quebec is called the liquidator. Same job, different title.
Okay, here's where it gets really interesting. The face amount on the policy is often just the floor. The final payout can be substantially higher or, in some cases, alarmingly lower. Let's dig into the financial variables.
This is critical knowledge because it shows that the policy is a living document. It's tied to performance and debt. First off, the type of policy matters immensely.
How so?
Okay, take in participating whole life insurance. If the policyholder chose to use their policy dividends to buy what are called paid-up additions.
They're essentially tiny, fully paid insurance policies that increase the final death benefit. Or if they left the funds to accumulate, that gets paid out too. But conversely, the benefit is reduced if they use dividends to pay premiums or if they already took out the cash surrender value.
And universal life is even more tied to performance, isn't it?
Oh, yes. Universal life policies offer different death benefit options. You could have a level amount or you could have death benefit plus the account value. If the option you chose ties the payout to the investment performance within the policy, then good investment returns can easily push the amount paid well past the original face amount.
So that accounts for increases.
Mm-hmm.
Now for the sobering part, deductions. Let's talk about loans and debt that can eat into that benefit.
There are three main deductions. The first is a collateral assignment. If the policy was assigned to a bank to secure a loan or a mortgage, the insurance company pays the outstanding balance of that loan to the creditor first.
Wow. So the spouse or kids only get what's left over.
Precisely. Look at the example of Zachary. He had a $500,000 policy he used to secure a business loan. When he died, the loan balance was $230,000.
Okay.
The insurance company paid that $230,000 directly to the bank. Zachary's wife received the remaining $270,000. It's exactly like a lien on a house. The debt gets settled first.
And what about a policy loan where you borrow against the cash value?
That's the second deduction. Any policy loan plus all the accrued compound interest is deducted from the death benefit. We saw this with Marva. She had a $500,000 policy but had an outstanding loan of $100,000.
Okay.
After 3 years of 4.5% compounded interest, that deduction had swelled to over $114,000. You have to remember that interest keeps accruing right up until the claim is settled.
And the third type of deduction?
Unpaid premiums. If the insured passes away during the policy's grace period, so the policy hasn't formally lapsed yet, the claim is still paid, but the benefit is immediately reduced by the amount of that unpaid premium. So Joshua's $250,000 policy was reduced by his $3,300 annual premium. The payout was $246,700.
Let's address the elephant in the room that confuses everyone. What happens if the policyholder accidentally misstated their age or gender on the application?
This is a tricky area, and it all depends on intent. If the insurer can prove the misstatement was fraudulent.
So they lied on purpose.
They lied on purpose. The insurer can void the policy entirely and deny the claim even if the policy is years old. But if it was a non-fraudulent, simple mistake, the benefit is adjusted.
Adjusted how?
It's adjusted to reflect the coverage the premiums actually paid would have purchased if the correct age or gender had been known at the time. The company is basically saying, we will honor the money you paid, but we have to recalculate how much insurance that money actually bought.
And that principle can result in a payout increase, which seems incredibly counterintuitive. Tell us about Paul.
Yeah, so Paul accidentally said he was 45 when he was actually 40. Since he was younger, he was paying the rate for an older, riskier person.
So he was overpaying.
He was overpaying. When he died, the insurance company determined his premium should have purchased more coverage for a 40-year-old. His original $100,000 policy was adjusted upward to almost $141,000. The mistake resulted in a higher payout.
Wow. But the opposite is more common, I assume.
Yes. Look at Leslie, who was male but was mistakenly recorded as female on his application. He got a lower premium. Since males have higher rates, the premium he paid was determined to have only purchased $77,500 in coverage at the correct male rate. The payout went down.
And we should note, in Quebec, while they allow for age adjustments, adjusting for misstated gender is not permitted.
Moving from the financial variables to just the pure logistics, one of the most common questions we hear is about timing. Is there a strict deadline for the beneficiary to file the claim?
I always just assumed you had to move quickly, like within 6 months or a year.
Surprisingly, no. There is no actual time requirement for filing a claim. Policies sometimes are found in filing cabinets years later. Yes. And as long as the policy was enforced at the time of death, the benefit will be paid. The insurer also has to pay interest on the proceeds for that whole period between death and payment.
That is very reassuring to know. But once the claim is filed, how long does the insurance company have to actually cut the check?
Once their investigation is complete and all the required documents are in, the insurance company must pay the insured amount within 30 days. But that investigation phase is what often takes the time. It can be weeks, even months, if they're doing deep due diligence, like investigating a potential suicide exclusion.
And the claimant doesn't have to take a lump sum, do they? What are the alternatives?
They absolutely have options. Instead of one big lump sum, they can choose to use the proceeds to buy an annuity. They might opt for a term certain annuity fixed payments over a fixed period, or a life annuity, which gives them payments for the rest of their life.
Okay, so what does this all mean when tax season rolls around? Is this sudden, giant influx of cash taxable income?
This is arguably the greatest financial feature of life insurance, and one people often misunderstand. The death benefit from a personally held policy is not considered taxable income for the beneficiary.
The entire amount is tax-free.
The entire amount, tax-free, regardless of how long the policy was held or how much was paid in premiums.
And that tax-free status covers the full amount, even if the payout, say, from a universal life policy, was way more than the original face amount because of investment gains.
Correct. The entire death benefit amount remains tax-free. And for policies owned by a corporation, the same principle holds. the corporation gets the benefit tax-free. And if it's a Canadian private corporation, some or all of that benefit gets credited to what's called the capital dividend account, or CDA, which means the corporation can then pass that benefit on to its shareholders as a special tax-free dividend, preserving that original tax advantage all the way through.
This has been a really necessary deep dive into the administrative reality of financial security. We've established that the claims process, it demands accuracy and patience. Agent support is crucial, but above all, those proactive decisions made by the policyholder seem to be key, especially naming specific non-estate beneficiaries. That's what truly saves time and gives you that critical probate tax exemption.
That really is the core insight. Life insurance is an essential piece of risk management, but it only delivers its maximum value if all the details are flawless. Considering the complex ways misstatements or policy loans or even a vague beneficiary designation can dramatically affect the final figure, the real takeaway for you is the critical importance of documentation.
Right.
The policyholder has to ensure every detail of the application and the ongoing policy maintenance is perfect. So the question for you is this: what specific documents, proof of age, beneficiary designations, loan balances, might you need to verify today to ensure your policy is truly maximized for the financial future of your loved ones? That is where the deep dive continues.